The Indian stock market has been on a wild ride recently, experiencing dramatic ups and downs that have left investors on edge. While it reached record highs in late 2023 and early 2024, the party seems to be winding down, with the market now facing significant headwinds. Since then, Indian indices have taken a tumble, leaving many investors puzzled and concerned about the future. This period of underperformance stands in stark contrast to the performance of global markets, which have, for the most part, continued their upward trajectory, buoyed by strong economic indicators. This divergence in performance raises a crucial question. What is driving this disconnect between the Indian market and its global counterparts? Is it a temporary blip or a sign of deeper issues? To understand this, we need to delve deeper into the numbers, analyze the forces at play, and consider both the challenges and opportunities that lie ahead for Indian equities. This involves looking at both domestic and international factors. The reasons for this performance gap are multifaceted, ranging from global macroeconomic factors to India-specific challenges, such as political instability and inflationary pressures. Understanding these factors is crucial for investors seeking to navigate this turbulent period and make informed investment decisions. It's about seeing the bigger picture and not getting swayed by short-term market noise. In the following sections, we will dissect the factors behind India's market movements and assess the outlook for the future, providing insights that can help investors strategize effectively. This analysis aims to provide clarity for investors, helping them to see beyond the short-term volatility and position themselves for long-term success in the Indian market. By understanding the underlying trends, investors can make more informed decisions. Let's start by examining the data in detail. The benchmark indices, the Nifty 50 and the Sensex, have witnessed a substantial decline since their peak in late 2024. The Nifty 50, which represents the 50 largest companies on the National Stock Exchange, has fallen by approximately 12% from its peak. Similarly, the Sensex, consisting of the top 30 companies on the Bombay Stock Exchange, has mirrored this decline with a drop of around 10%. These figures highlight the magnitude of the correction in the Indian market. In contrast, global markets have shown greater resilience and stability. The S&P 500, a key index for the US stock market, has risen by about 5% during the same period. Similarly, other major indices, like the FTSE 100 in the UK and the Nikkei 225 in Japan, have also posted modest gains. This disparity in performance underscores the underperformance of Indian equities relative to their global peers. The data paints a clear picture. While global markets have continued to climb, albeit at a slower pace, the Indian market has experienced a noticeable correction. This divergence demands a deeper investigation into the underlying factors at play in the market. One of the key drivers of any stock market is the flow of institutional funds. These funds can significantly influence market trends and investor sentiment. In India, two major players dominate this landscape: foreign institutional investors, or FIIs, and domestic institutional investors, or DIIs. These entities play a pivotal role in shaping the market's direction. FIIs are entities like foreign pension funds, mutual funds, and hedge funds that invest in Indian assets. They bring in substantial capital from overseas, impacting liquidity and market performance. DIIs, on the other hand, are Indian financial institutions such as domestic mutual funds, insurance companies, and banks. They mobilize domestic savings and channel them into the stock market. Over the past year, the dynamics between FIIs and DIIs have been particularly interesting. Their contrasting actions have created a unique market environment. FIIs, often seen as the bellwether of foreign investment sentiment, have turned net sellers in the Indian market. This shift has raised concerns among market participants. Data from the National Securities Depository Limited shows that FIIs have pulled out a net amount of approximately $15 billion from Indian equities since the start of 2025. This significant outflow has put pressure on the market. In contrast, DIIs have emerged as net buyers, providing a crucial counterforce to FII selling. Their confidence has helped stabilize the market to some extent. Data shows that DIIs have invested a net amount of approximately $10 billion in Indian equities during the same period. This inflow has been a positive sign for the market. This suggests that while foreign investors have been reducing their exposure to India, domestic investors have shown greater confidence in the long-term prospects of the Indian market. Their optimism is a beacon of hope for sustained growth. This tug-of-war between FIIs and DIIs has had a significant impact on market sentiment and price movements. The interplay between these two forces is crucial for understanding market behavior. Understanding the rationale behind their actions is crucial to deciphering the current market dynamics and anticipating future trends. By analyzing their strategies, investors can make more informed decisions. Turning our attention to the factors behind India's underperformance, three key issues stand out: valuation concerns, FII outflows, and sectoral weaknesses. These elements have collectively created a challenging environment for Indian equities, leading to the correction we have witnessed. Let's examine each of these in turn. First, valuation concerns. After the impressive rally in 2023, Indian market valuations reached elevated levels. This surge was driven by a combination of strong corporate earnings, positive investor sentiment, and a global liquidity boost. The price-to-earnings ratio, a common metric for measuring valuations, touched historically high levels, indicating that stock prices might have gotten ahead of their underlying earnings growth. This raised concerns about whether the market was becoming overheated and due for a correction. Second, FII outflows. As discussed earlier, FIIs have been net sellers in the Indian market, pulling out billions of dollars. This trend has been influenced by several factors. One major factor is the rising interest rates in developed markets, which make investing in those markets more attractive. Higher returns in developed economies often lead to capital outflows from emerging markets like India. Additionally, concerns about the global economic slowdown and geopolitical uncertainties have prompted some investors to adopt a more cautious approach, leading them to reduce their exposure to emerging markets like India. This cautious stance is understandable given the volatile global landscape. Lastly, sectoral weaknesses. While the Indian economy has shown resilience overall, certain sectors have faced headwinds. These sector-specific challenges have had a significant impact on market sentiment. The IT sector, a major driver of India's stock market, has been impacted by slowing global demand and reduced IT spending by businesses. This slowdown has been a significant drag on the market. Similarly, the automobile sector has been grappling with supply chain disruptions and rising input costs. These issues have hampered production and sales, further weighing on market performance. These sectoral challenges have weighed on overall market sentiment. Investors are cautious, and this caution is reflected in the market's performance. These factors, in combination, have created a challenging environment for Indian equities, leading to the correction we have witnessed. However, it's essential to remember that market cycles are a natural part of any economy. Understanding the underlying reasons behind these cycles can help investors position themselves accordingly. By staying informed and adaptable, investors can navigate these challenges and potentially find opportunities even in a downturn. In conclusion, while the current environment is challenging, it also offers a chance for investors to reassess and strategize for the future. The key is to stay vigilant and informed. Market cycles are inevitable, but with the right approach, investors can weather the storm and emerge stronger. What's important is to understand the underlying reasons behind these cycles and position ourselves accordingly. By doing so, we can navigate the complexities of the market and make informed decisions.
Smack that like button. Don't forget to subscribe for more fun videos and share it with your friends. Your support keeps us going, so be sure to join our awesome community. Hit that bell icon too, so you're always in the loop. Thanks for watching, and we'll see you in the next one.